Foxconn has announced its bankruptcy and mass layoffs. TSMC has also announced its withdrawal from China. NVIDIA can no longer endure. The Chinese economy has completely collapsed following the announcement from Morgan Stanley. Professor Takahashi Yuichi recently presented a compelling analysis of Foxconn's announcement of bankruptcy and its subsequent massive layoffs, highlighting the profound impact this has had on both the company and the Chinese economy. Foxconn, long regarded as one of the pillars of China's manufacturing sector, has faced growing challenges in recent years. According to data from within the company, Foxconn's factories in Shenzhen have seen workers struggling with inadequate wages, earning approximately 3,900 yuan a month. This figure is shockingly low given the high cost of living in these industrial regions. The increasing dissatisfaction among its workers, coupled with rising operational costs, has created a volatile environment that is no longer sustainable. Foxconn's announcement of bankruptcy and large-scale job cuts is not just a blow to its employees but also a severe setback for China's industrial infrastructure. China has heavily relied on Foxconn's vast manufacturing capabilities to maintain its status as the world's factory. However, the economic pressures on Foxconn are a reflection of deeper, systemic issues in China's economy. The rising costs of electricity, water, and raw materials have strained the company's ability to maintain profitability. These burdens, along with China's stringent labor laws, have forced Foxconn into a position where bankruptcy became inevitable. The global context further exacerbates Foxconn's struggles. U.S. China trade tensions have severely disrupted the supply chain, cutting off access to essential components and limiting Foxconn's ability to export products, particularly those destined for major markets such as the United States. Professor Takahashi pointed out that the escalating trade war has acted as a catalyst, accelerating Foxconn's financial decline and forcing the company to reconsider its reliance on China as a manufacturing hub. The company's eventual decision to declare bankruptcy is seen by some experts as a direct consequence of China's economic policies, which failed to provide adequate support to large foreign enterprises. This announcement has sent shockwaves throughout China's manufacturing sector, which is already under pressure from labor shortages and rising costs. With Foxconn cutting a significant portion of its workforce, thousands of workers have been left unemployed, further contributing to China's growing unemployment crisis. The impact extends beyond just the job market, as entire supply chains built around Foxconn's operations are now in jeopardy. Suppliers, logistics companies, and ancillary businesses that rely on Foxconn's production lines are now facing an uncertain future. Professor Takahashi stressed that this domino effect could lead to a more extensive economic slowdown if the situation is not addressed promptly. China's economic stability is now at a critical juncture. The Chinese government has long promoted the idea of dual circulation, a strategy that aims to reduce reliance on foreign markets while boosting domestic consumption. However, Foxconn's collapse reveals the fragility of this strategy. Without key foreign investors like Foxconn, China's goal of self-sufficiency seems more distant than ever. As Foxconn pulls out, the loss of one of its most prominent foreign employers underscores the challenges China faces in sustaining its industrial output. Professor Takahashi concluded by stating that the fall of Foxconn is a wake-up call for Chinese policymakers. If large multinational corporations like Foxconn cannot survive in China's current economic environment, it raises serious concerns about the future of foreign investment in the country. As more companies reconsider their presence in China, the Chinese government will need to take drastic measures to restore confidence in its market, or risk losing its position as the world's manufacturing leader. In a detailed analysis presented by Professor Takahashi Yuichi, the recent decision by TSMC to withdraw from China is viewed as a significant turning point for both the company and the broader Chinese economy. TSMC, as the world's leading semiconductor manufacturer, has long played a crucial role in China's industrial landscape. Its factories in China, which are vital for the production of advanced chips used in everything from smartphones to artificial intelligence systems, have been a key part of China's ambitions to dominate the global technology sector. However, mounting challenges have led TSMC to reconsider its presence in the country, and the company has now officially announced its plans to pull out of China. According to Professor Takahashi, this move is driven by a combination of internal and external pressures. One major factor is the rising cost of doing business in China. Much like Foxconn, TSMC has faced increasing production costs, including higher wages, electricity prices, and logistical expenses. These growing overheads have strained the company's profit margins, making it difficult to maintain the same level of efficiency and competitiveness in its Chinese operations. Beyond these financial concerns, TSMC has also been impacted by the ongoing geopolitical tensions between China and the West. The escalating trade war between the U.S. and China has not only disrupted supply chains but has also placed TSMC in a precarious position as it navigates between two economic superpowers that both rely heavily on its semiconductors. Professor Takahashi pointed out that TSMC's decision to leave China is not just a corporate restructuring, but a reflection of a broader trend of disengagement from the Chinese market. Over the past several years, foreign companies have grown increasingly wary of China's business environment. The unpredictability of government regulations, coupled with Beijing's tighter control over foreign enterprises, has made the country less attractive to multinational corporations. TSMC, despite being a major player in China's technology ecosystem, is not immune to these concerns. For China, the implications of TSMC's departure are profound. The country has invested heavily in building its own semiconductor industry, but it remains heavily dependent on foreign technology. TSMC's withdrawal leaves a significant gap in China's supply chain, particularly in the production of advanced chips that are critical for industries such as artificial intelligence, telecommunications, and military technologies. This retreat, according to Professor Takahashi, signals that China's ambitions to achieve technological self-reliance are still far from being realized. Moreover, the loss of TSMC will have a cascading effect on other sectors of the Chinese economy. Numerous domestic companies that rely on TSMC's chips will now face shortages, which could slow down production across a wide range of industries. This will likely exacerbate China's existing economic struggles, as the country is already grappling with a real estate crisis, rising debt, and slowing growth. Professor Takahashi highlighted that the timing of TSMC's departure could not be worse for Beijing. At a moment when China is trying to stabilize its economy and project strength on the global stage, losing a key foreign investor like TSMC only further exposes the vulnerabilities in China's economic model. In reflecting on the broader significance of TSMC's exit, Professor Takahashi suggested that this may be the beginning of a larger exodus of foreign companies from China. With TSMC, one of the most advanced technology companies in the world, choosing to leave, it raises serious questions about the future of foreign investment in China's high-tech sectors. Without access to cutting-edge foreign technology, China's ability to compete globally will be severely hampered. Furthermore, this development could have long-term consequences for China's strategic goals, including its efforts to dominate the fields of artificial intelligence and quantum computing. The struggles of NVIDIA in China were framed as yet another sign of the deeper economic challenges the country is facing. NVIDIA, one of the world's largest manufacturers of graphics processing units (GPUs), has long been a dominant force in both the gaming and artificial intelligence industries. Its advanced chips power everything from high-end gaming computers to data centers and machine learning algorithms. However, despite NVIDIA's crucial role in these sectors, the company is now finding it increasingly difficult to sustain its operations in China, as mounting pressures have left it on the brink of exiting the market. Highlighted that NVIDIA's difficulties are emblematic of a broader pattern affecting foreign tech companies operating in China. For years, NVIDIA thrived in China, benefiting from the country's growing demand for cutting-edge technology and its booming gaming market. Yet, as economic conditions have worsened, NVIDIA's growth has stalled. The company has been battling fluctuating stock prices, with its shares reaching around $140 but unable to sustain the upward momentum. This instability, according to Professor Takahashi, is partly due to China's slowing economy and the increasingly hostile regulatory environment for foreign tech firms. NVIDIA's troubles in China are not merely financial, they are also deeply geopolitical. As the trade war between the U.S. and China continues to escalate, NVIDIA finds itself caught in the crossfire. Many of its products, especially those used in artificial intelligence and advanced computing, are now subject to strict export controls imposed by the U.S. government. These restrictions are designed to limit China's access to high-end technology that could be used for military purposes. As a result, NVIDIA has been forced to navigate a complex web of regulations that severely limit its ability to sell some of its most valuable products in China. Beyond these geopolitical challenges, NVIDIA is also facing intense competition from Chinese tech companies that are increasingly capable of producing similar technologies. Domestic firms, like Huawei, have made significant strides in developing their own GPUs and AI chips, which threatens NVIDIA's market share in the country. This growing competition, coupled with the pressures of U.S. export restrictions, has placed NVIDIA in an untenable position. According to Professor Takahashi, the company is now at a critical juncture. It either needs to find new ways to compete in an increasingly restrictive market or consider scaling back its operations in China altogether. For China, the potential loss of NVIDIA would be a severe blow to its technology ambitions. GPUs are not only crucial for gaming but also for artificial intelligence and data processing, areas where China has been investing heavily in recent years. Without access to NVIDIA's advanced chips, many of China's tech firms will face significant challenges in keeping up with global competitors. This would, in turn, slow down the country's broader efforts to establish itself as a leader in AI and other frontier technologies. According to the analysis paints a bleak picture of NVIDIA's future in China, suggesting that the company may soon follow the path of other tech giants like TSMC and Foxconn, who have already begun scaling back or withdrawing entirely from the Chinese market. The challenges facing NVIDIA are not unique but are part of a broader trend of foreign companies finding it increasingly difficult to operate in China's complex and restrictive economic environment. As more firms like NVIDIA consider exiting, China risks isolating itself from the cutting-edge technology that has been vital to its economic growth over the past few decades. In conclusion, NVIDIA's predicament is a clear indicator of the deepening cracks in China's economic and technological foundations. With foreign tech companies leaving or downsizing their operations, China's dream of becoming a global leader in AI and advanced computing appears more distant than ever. The loss of key players like NVIDIA will have ripple effects across the Chinese tech ecosystem, leading to slower innovation and diminished competitiveness on the global stage. Professor Takahashi Yuichi's analysis on the collapse of the Chinese economy, following Morgan Stanley's dire warning, offers a stark perspective on the severity of China's financial troubles. Morgan Stanley's announcement underscored what many economists have been fearing for years: the Chinese economy is teetering on the brink of collapse. The combination of rising debt, a slowing property market, and growing internal and external pressures has left China facing a crisis that even its government seems unable to contain. One of the most alarming aspects of Morgan Stanley's report is the sheer magnitude of China's local government debt. Local governments across the country have accumulated massive debts, largely through borrowing for infrastructure projects and real estate developments. While these investments were once viewed as a driving force behind China's rapid growth, they have now become a crushing burden. The property sector, once the backbone of China's economy, has started to collapse under the weight of unsustainable debt levels and decreasing demand. The housing bubble, which has been building for years, is now bursting, leaving unfinished projects, unsold homes, and mounting losses across the board. As a result, entire regions are grappling with severe financial instability, which has been exacerbated by the inability of local governments to repay their debts. Morgan Stanley's forecast suggested that China would need to inject trillions of yuan into its economy to prevent an immediate collapse, but even that might not be enough. The ongoing crises in the property and debt sectors have severely undermined confidence in the Chinese economy. Investors, both domestic and foreign, are growing increasingly wary of putting money into a market that is becoming increasingly volatile and unpredictable. Being emphasized that this crisis has been building for years, but it has now reached a tipping point where the government's traditional methods of intervention, such as cutting interest rates and injecting liquidity, are no longer sufficient to stave off disaster. China's attempts to prop up its economy have been met with diminishing returns. Despite injecting massive amounts of capital into the stock market and banking system, growth has stalled, and the stock market continues to fluctuate wildly. Morgan Stanley's analysis warned that if the current trajectory continues, China could face a full-blown financial crisis, the likes of which it has not seen in decades. The sheer scale of the debt problem, estimated at over 110 trillion yuan, makes it almost impossible for the government to manage without drastic measures. Beyond the debt and property crises, China's broader economic challenges have only added fuel to the fire. With companies like Foxconn, TSMC, and NVIDIA reducing or ceasing operations in China, the country's manufacturing sector is rapidly losing its competitive edge. The loss of these major players not only affects employment and economic output but also undermines China's goal of becoming a global technology leader. The technology sector, once a symbol of China's economic prowess, is now increasingly seen as a weak point as more foreign companies reconsider their future in the country. Professor Takahashi pointed out that Morgan Stanley's analysis is a stark wake-up call for Beijing. The strategies that worked for China in the past, massive infrastructure projects, aggressive investment in real estate, and rapid industrial expansion, are no longer viable in the current economic climate. China's over-reliance on these sectors has left it vulnerable to the kind of collapse that Morgan Stanley now warns about. The Chinese government, long praised for its ability to manage its economy, is now struggling to find new solutions that can restore confidence and stabilize the market. In the broader context, the impact of a Chinese economic collapse would extend far beyond its borders. China's role as a key player in global trade means that any major downturn in its economy would have ripple effects throughout the world. A collapse in China's financial system could lead to a global economic slowdown, affecting markets from the United States to Europe and beyond. Takahashi concluded by noting that Morgan Stanley's warning should not be taken lightly. China's economic model, which has been under strain for years, may finally be reaching its breaking point. If significant reforms are not enacted soon, the world could witness the most significant economic collapse of the 21st century, with China at its epicenter.